operate from the adjustment that we're gonna have a 10% rundown, if we go down, if we go down, 100 points today, the idea that, we're almost halfway towards that 10%. I mean, because we've already come down a good number of points already. We're probably net at like 7 or 8% already in the drawdown. So then if we can get a 90% out of the money play, we can have even more runway. So that's kind of the idea behind it. If we're going down tomorrow, we won't do it tomorrow. We'll wait till, Wednesday. That's the trick, is you can still get the trade in for 3 DTE and get a great credit and still play the percentages. So just the strategy behind it.
What are your thoughts about a single put?
I mean, so I'll say this, right? If you've got the capital, yeah. But the problem is that for most people, um, for a lot of people, it's very capital intensive.
Hmm.
You know, um, personally, if I were to do a trade like that, I do it in the MES because the collateral they're going to hold for you won't be as much, and you can get almost the same
Yeah.
credit
Yeah.
you'd get for like
Yeah.
running it on SPX.
Hmm.
The difference is, of course, is that SPX is cash settled and the MES futures are not. So there is, assignment risk if it goes in the money. That's the only, the problem with any type of naked play, be it a short, whatever it is, the longs or shorts, is that, when you're doing a spread, right, you have, in theory, you've got the other option, that long option, to give you some protective support. So as your Greeks increase, they're increasing on both of them at the same time, so you don't get burned out as fast. That's why with those synthetic type spreads that a certain, you know person likes to do, where they do like a 50 wide spread, you're really not, you have no protection, because when the underlying starts heading towards that short, the long is so far out that the deltas and the gamma and the vega and the voma and all this stuff, they don't increase fast enough. It doesn't keep pace. When you got a tight 4 or 5 point spread, they're almost going up at the same rate, so you don't get burned out as quickly. So
I was thinking more about us buying a put so you don't have that same
right,
risk.
right. The problem with buying a put in this inflated environment is that
Hmm.
because volatility is so high, you're paying a
Mm.
huge premium to buy a put.
Oh, I see.
Yeah. So what ends up happening is the example I'm going to give you is AMC, right? So when AMC spiked up, we'll say like in April or May, they had that big spike up, right? I know people who actually bought calls on AMC, but the problem is, and they went out 6 months to a year, but the problem is they paid so much volatility that the
Yeah.
moment the volatility shrank, even though they were in the money, they were actually getting less money back. They were losing money on in the money option
Mm.
because the volatility bled out of it. So that's the downside to that. If volatility is going up like it is right now, be a net seller. Net seller. That's the way to play it. Because
Yeah.
then when the volatility drops, boom, you make money instantaneously because it's
Yeah.
worth less than what you got paid to go in for it.
Yeah. That makes perfect sense. Thank you.
No
I
problem.
get it now.
Exactly, Vega Crush or IV Crush. Exactly, big rounds.
So would that be what we're doing essentially on zero DTE days? What would be the Greeks that we're watching for the most when we do credit spreads?
Delta and Vega. Because the reality of it is there's not a lot of theta value in the option on a zero DTE. Depending upon where you're getting it, how closer to the money, 5 to 15 cents per. And then when you buy the long, that's offsetting it by 5 to 10 cents. So there's not a whole lot in it. Again, depending on the width of the spread. If we're doing a 5 point wide on SPX, the theta that's in there is 5 to 10 cents net between the long and the short. So, but when that price movement comes in, you're getting that delta decay, and then obviously, like with today, the volatility decay did come in because we were at like a 40 or 50 point during the course of the day, right? On a same day option, the volatility is going to decrease because as time moves on in the day, when there's only 20 minutes left in the day, the price theoretically isn't going to move 50 points. So during the whole course of the day, your Vega decay, your expected move is decreasing and decreasing and decreasing, and you're getting all that IV crush, that Vega crush.
I think that might be a misconception that people don't know. They automatically always think that it's theta,
Oh,
but
absolutely.
theta would probably be theta would be, would you say, good for a 21 DTE?
Yeah, yeah. Anything longer, honestly, anything longer than like 4 or 5 days, there's more theta in the play. But I mean, the reality of it is that people hear so much about theta, theta, theta. They think there's like oodles and gobs of theta in it, when really, you know, the reality. Yeah, actually, the reality of it is anything less than like a week, anything less than 4 days, there's not a lot of theta left in the option chain, especially when you're doing a spread and a tight spread at that. When you're doing, you only have five points, because you're getting 45 cents in theta and you're short, but you're paying 35 cents in theta for your long. So you're only net 10 cents theta. Everything else in that pricing is your volatility and your delta, depending again how close you are to the spread. That's why like far out of the money spreads, like your delta 5 spreads on 0 DTE, they're so risky because any type of movement, you're subject so much to like Vanna and not so much charm because it's so low. So charm does help you, but you're so you can be gamma spiked and you can get Vanna. It can just blow you out. With a small move in your direction. And now if you're cash settled, okay, it's fine. You're never at risk. But like if you've got something like on SPY, or if you've got like a 0 DT trade on like Google or Amazon or something that actually does move a lot, yeah, you can get volatility blown out. And if you honor a 3x or 2x stop loss, you're done. So, a lot of times, to me, a 30 delta is a hell of a lot more safe than a point zero 0.05 delta.
Yep. So one other question: what about over the weekend decay? Is there such
Nope,
thing?
it's priced in, or it's priced out, I should say. So what they do is, so the IV calculations and the theta calculations, what they do is they base it on the 250, whatever number of trading days there are in a year. So it's like it's 52 times 5, and then they subtract out the 2 or 3. I think there's 6 or 7, like the market is closed holidays. They subtract those out, and that's how they do their calculations.
252.
Yeah, and that's how they do it. That's why Rule of 16 works. So, this idea that I'm going to do a 7 DTE trade instead of a 4 DTE trade because I'm going to get some magical weekend theta decay. They don't know what they're talking about. Whoever told them that is ignorant. Doesn't exist. And you can look at the option pricing contracts. Look at what you get for a Monday to Friday versus a Monday to Monday, and it's not that much more. It's not like you're getting 3 days worth of theta built into it. And again, it's just how it works.
You do actually see quite a few people that try to pick. They think that they're getting a 20. If you pick a 25 credit option, they think that they're being safer. Would you say that because we're so predicated on delta on 0 DTEs, that it's actually more dangerous than a closer to the money strike?
Absolutely. Because if you're gonna honor a stop loss, see, like that's the thing. It's like the first question, the first answer to that question is, do you have a stop loss? Are you letting odds and percentages play out, or do you have a stop loss? So if your answer is I'm just gonna let the odds play out, then it's probably a safer trade because you're not going to react to any price movement. You're basically saying, I picked these strikes, let the cards fall as they may. And if you're going to do that, yeah, you probably have a safer trade. from the standpoint of, it's cash, SPX is cash settled. If you have the 4,400 strike and it ends at 4401, you're good to go, or 4,401 penny. It's out of the money. You're good to go. You win max win. I had a rut trade like that one day. I couldn't close it. Rut shit the bed, crap the bed in the last few minutes of the day. And it's 3, 4 minutes before close. It started dropping, dropped like 20 or 30 points, like right at the end of the day. I couldn't. You can't get a fill on rut to close it to begin with. And then I ended up like 1 or 2 cents out of the money. So it was a max win trade, but that's that's cash settled. But if you're not cash settled, or if you actually have a 3x stop loss or 2x stop loss, yeah, your trade's much riskier because if you receive 20 cents credit to get into the trade and it just moves against you, you're gonna hit 60 real quick. If you have a 60 cents credit, even though it's closer to the money, it's gonna probably be harder for you to get hit to $1.80 than that guy is at 20. That's because of the way, again, part of it is with that lower delta trade, Vanna actually has higher effect on that lower delta trade than it does your higher delta trade. And Vanna is a function of volatility. It's a function of how volatility pricing. It's a function of how Vega affects delta as the price moves in your direction. And Vanna
So
is in. And Vanna's in. So what happens Vanna is almost like inversely related. So when you're short, you're positive Vanna. So so on a short call on a short put, your Vanna is positive, and the long call Vanna is negative. Um, so what ends up happening is when the price moves against you, and you have that, and it's not only is it inverse, it's also higher at lower deltas. So the closer you are to the money, the less that Vanna is going to affect that particular option. So that's how you get screwed out with things.
those second order Greeks are kind of all the rage right now.
Yeah,
Vanna and Charm specifically, because
yeah,
there's this individual that is kind of making a bunch of money because he's very smart, does very well,
right,
and he's making quite a bit of money off of Vanna and Charm. And Charm is a big one.
right.
Those are things that I didn't even know existed until maybe 3 weeks ago.
Yeah, Rick, I've been talking about the higher order, the second and third derivative Greeks. I've talked about them for years. Um, I'm not a talking head that people care to listen to. When I used to talk about speed, people would look at me like, "What the hell's speed?" You know, it's the gamma of gamma. I don't know how to explain it any other way than that. That's the best way to explain it. Sort of, throw a bunch of math at you.
Yeah, you're not going to get this type of education anywhere else. That's the bottom line. Friday, when you gave your little discussion, I was in the middle of doing something, but I was able to take notes while I was doing it. And then I went back and I kind of went through that stuff. And that's kind of why I was asking you those questions, because I feel that everybody really needs to know that stuff. What are we looking for? What are we trading? What is it that we're identifying? And
Right,
honestly, we're
Not
just better for it. We really are.
right.
not
And
only
and
that,
part
it's
and
gonna
part of
be
the
archived.
right. And part of the educational stuff that I'm going to be doing, I'm actually in the process of making YouTube videos where I explain a lot of the optiony type stuff. As far as the Greeks and different type of strategy, that type of stuff. That's one of the things I'm doing. So obviously in part for members, so they can see it. Obviously in part so people can see it and be like, hey, these people know what they're talking about. Let's go join them. Um, Rick, what I was going to say before
Yeah.
was like I guarantee you've never even heard of color.
Color?
Color. You've never even heard of it.
How do you spell that? COLOR?
Yeah, COLOR.
Okay. Let
It's
me
the
Google
measure.
it.
It's gamma decay. It's the measure of how gamma decays over time. And basically, the less time there is in an option, and the farther away you are from the money, less gamma is going to move. It's gamma decay, but you've never heard of it because no one talks about it. But it's a, it's an imp- it, It's not super important, but it's part of the overall equation of it. Because basically you've got speed and you've got color. Speed is the gamma of gamma. Color is the measure of. So basically, when the price of an underlying moves a dollar up or down, delta will change to the order of gamma, and then gamma will go up or down to the order of speed. So that's why
Where
that's why like
where did you
it's
learn this?
books, man, books. I've been studying books for like 15 years, 15, 20 years. I
Do
was
you
I
have
was
like an order that we can start reading in so that maybe we can get up to speed? Because I do see there's quite a few people that are listening that are wondering,
Yeah.
and I'm definitely one of
So
them.
in the education tab,
Yep, yep.
I have a Dropbox. I have a link to my Dropbox with all my PDF books. Everything that I have that's on PDF is in there. And there's some of the best trading books, and then of course we have all the other books that are in there too. I have the CRM manuals or CMT manuals, which are the manuals that basically if you wanna when we were talking before about how what's his face is basically like an understudy. He's learning to become a trading guy. Who I forget who he said it was over in the other channel. Um,
Oh, Mario.
yeah,
Yep.
these are the type of books they're like the study guide books. There's three levels of them. They're like $300-400 books on Amazon. I have level one, two, and three. They're like 1,000-page books. All the technical stuff you ever want to learn in them. Everything. They're thick. They're not. Like let's read before we're going to bed. And if you study 10, 15, 20 pages a day, and really like absorb the material. So it take obviously they're study guide books. To take the training, the CRE test or whatever the test is, I forget that they give to become a trader. But yeah, it's just stuff like that. I've consumed these things over the years. You know, I was a computer salesman when I worked for Gateway Computers. If you remember the company Gateway, I was
Oh
a
yeah.
computer salesman for Gateway when like E-Trade and Schwab and all these companies first started doing online trading stuff. And I was like, oh, this stuff seems interesting, you know. And I didn't do it full time because I was a stupid kid, who if I had done it full time back then, I'd probably be a bazillionaire right now. Like I joked about how man, I should buy a stock of this Amazon company. They sound interesting. Should have done it. You know, didn't, but you learn. When I make my time machine, I'll go back in time and fix that. Um, but yeah, I mean, I've been doing this stuff for a long time, and reading a lot of stuff for a long time. So yeah, I mean, a lot of those books in there, they talk a lot about a lot of that stuff. But you know, at the same time, to throw it out there, right? There's a lot of information on some of these options. Some of these option Greeks, depending on the length of term you're trading, are more and less important than others. So that's part of it too. Is that sometimes you get into that overanalysis paralysis where well, I wonder how this eighth derivative Greek is going to affect my trade. Like it's not going to affect your trade. But that's understanding understanding the way Vanna works is why I think that like long-term low delta trades is just a bad strategy. That's the same reason why Tasty works or Tasty Trade thinks it's a bad strategy because they understand that that 5 delta trade that's 30 days out is more subjective to this type of risk when the underlying moves in your direction. And they recognize that. Whereas a higher delta trade isn't as subjected to that. So and then again, if you honor stops and you honor these types of things, then it becomes apparent. And it's a lot of it is just the mathematics of it working out over time. What's the smartest way to you know hedge the odds in your favor a little bit? you know I'll say this: at the end of the day, And I said this the other day, delta's king. Price action is king. Throw everything else out the window. If you can get direction right and you can get a good fill, which is what, again, what we preach, right? You're going to win more times than not. Period.
I'm thinking that that might be what needs to be introduced into the trading uh, profession, because it seems like that we get entangled in, like you said, analysis paralysis because of the misinformation. And there is quite a few people out there that are giving misinformation that have not proven that they're successful.
Right.
And I think it's a big reason why people are not successful. They're getting so caught up in things that are just not necessary. When, like you said, we've got zero DTE. If you want to make a good amount of money, make a living, you can do it off of zero DTE. You've got other things like 21 DTE, but the dynamics of the trade are pretty different. And that stuff needs to be known. And it's people just don't know how to teach it. They don't know what it is. They don't know how to deliver the material. And I mean, even just talking today, for me personally, when you talk through something like this, it clicks. It really starts to click, and it's very very exciting because this stuff is awesome. But then when you've got people that are as smart as you guys and how you're teaching us stuff, and you're also making money at the same time, you can't beat that. I mean, you really can't. This is just something that's way out of the realm of imagination. You wouldn't think that you could have even imagined something like this.
No, I mean, absolutely. I mean, that's why I'm here, and full disclosure, I about 25% of my job is training and teaching. So I'm a little bit used to explaining things to people and having to explain alternate ways. If you don't get version A, then I try to explain it version C, B, and I'll try version C. So,
And
and
what comes after that? Because
well, that's when I take a baseball bat and I put a note on the end of it and I just pound it into your head and I try to get it through like physical osmosis. That
you
hasn't
know,
worked yet, but I put a couple people in the hospital. But I work in a hospital, so the location isn't very far away.
that's funny. I feel like I might need that. But because, I understand it in theory. Like I understand the definitions and, the Greeks and how they interact, but it doesn't translate into action. What you guys are doing is saying, okay, take this here and this is what see helps because you can get stuck in that theory, in that analysis paralysis. That's what happens to me.
Yeah, absolutely. Sometimes the theory is better for identifying if you're getting a good value for something, and that's almost more important in a way. And this is part of what we were talking about the other day on Friday was that sometimes, when you're anticipating the way something should move, if the if you're not getting the right pricing for it, it's not a good deal. And that's a big part of it as well. If that makes any sense.
Yes, it does, actually.
Yeah,
That's
it
good.
does.
So it's and part of that is like, see, like this is where like understanding the option stuff makes sense to me, or like I put it in like practical use, right? So when the price of an underlying is moving away from your spread, so let's say you haven't put a spread on yet, right? So let's say you're eyeing, the 4400, 4405. If the price is moving away from it, you're that's the price in that option chain is going down. When the price is moving towards it, it's going up. So that's why you want to wait till it comes back towards you a bit to get that better fill. Otherwise, you're chasing the premium. So that's an example of like how you use these deltas in without understanding like the core of how all of them work. That's how you understand like the theory craft behind it. You know, if you think a specific strike is valid and it won't cross, you wait till you get the absolute best amount of money to get it. Now, sometimes what that means is you can't take a trade because it never comes back. It just runs away. And honestly, if that happens to me, that's a perfectly valid, if you didn't take a trade because you couldn't get a good fill, that's a valid reason not to take a good trade. Because you're better off getting a better fill for that trade than not, and then having it come back at you. Then it does come back, and now you hit that stop loss because you got in at 30 cents when you could have got in at $1.20. So that's where the theory craft comes into play. Is being able to look at something and on the other hand, like if you have a very low volatility day, you're not getting a lot of premium. That's the danger then of saying like, so in a case like that, right? So like if you have a very low volatility day, let's say you wake up in the morning and the volatility for the day is 9, the expected move is 9, right? That's the type of day where if you feel really righteous about a strike, you might be better off taking the debit play and not the credit play because you're getting crap for credit. So if you take the debit spread and then volatility increases, you make money because because your spread is now worth more money than less money. Because if you take the credit spread and volatility increases, now the price to buy it back has actually gone up. So now you're upside down. So that's where understanding like the where value and that's and I don't like doing debit spreads, but there's days and there's times where it makes more sense to do that type of play if you're expecting a huge volatility increase.
Okay, I have a question. Aren't we expecting a volatility increase on Wednesday before the FOMC meeting?
Normally, but I don't know how much higher it's going to go than it is right now. I mean, it's pretty high right now.
Mm,
What
okay.
what you tend to see before that is sometimes you don't see necessarily a volatility increase. You see a volatility hold where it
Hmm.
doesn't necessarily increase, but it doesn't decrease either like it should. Like normally throughout the day, right? Almost like at an hour level, the daily volatility will collapse. But in days where there's big meetings or that you don't see that volatility decrease until the meeting happens or the president speaks or whatever the big news of the day is, it'll hold. It'll decay a little bit, but not to the magnitude it normally does.
Okay, got it.